Certainly. So york.ie is a hybrid strategic growth and investments company. So we are vertically integrated to help early stage companies, both from an investment standpoint as well as an advisory standpoint. So we're very unique in the market in terms of being early stage capital, but we have the ability to be very active. And in doing so, we've set up a group of services that include things such as go-to-market, R&D, HR and recruiting, finance and capital strategy, marketing competitive intelligence. So as a small investment company, however, we're a 32-person today, full-time employees at york.ie, and really rethinking the way that startups are built, scaled, and monetized. We saw the need, and we've been in the startup world for a long time now, and we saw the tremendous need for active capital at the earliest stages. And so we really thought about, disrupting the traditional venture model and how to really align incentives between founders, entrepreneurs, investors, and in our case, also investment partners, or sometimes referred to as limited partners. So we're a unique model in that way, but we've thought about and talked to startups, over hundreds and hundreds of startups over the years, and have determined what the greatest needs are, and we've built a model to full service. Certainly. So first and foremost, we're a B2B investor, right? So all enterprise software, earliest stages from pre-revenue to, significant sort of product market fit, which I know is one of the key topics for today. The stages, obviously the definitions sway a bit, but anything from sort of pre-seed, seed, C plus up to Series A, depending on what coast you are, those definitions might be quite different. And we go all the way down the stack, up the stack. We come from an infrastructure background, so there is some bias towards, infrastructure companies, cybersecurity, DevOps, dev tooling, cloud native, but we go all the way up, all of the applications, and some vertical SaaS plays, and even some digital health these days. So it's a pretty broad portfolio approach. Our check sizes, range from, call it, 500K to 2 million, depends on factors there. We're happy to lead deals, or co-lead or participate. So, no big deal on that front. So we've got, a pretty wide early stage investment thesis. Again, key being recurring revenue, all B2B. And we love what we call founder market fit, which we can talk about a bit later as well. Question. We fundamentally believe in, again, all of this is based on us being former operators, right? We're operators helping operators, and that's a key to our model. So when we think about go-to-market strategy for us, right, one of the fundamental pieces are thinking about it from a bottoms-up perspective. Obviously the key factors of product market fit are how big is your market, who are your customers, are you replacing something, is anyone else disrupting this market, and then all of the metrics that attach to that. But for us, I think the key pieces are, understanding your ideal customer profile, your ICP, being able to build a repeatable go-to-market motion, right? Those are some of the key elements that we look for. And these days, everything about, self-service, product-led growth, up to direct sales, enterprise sales. And every company and every market's different. However, we'd like to see, in often cases, multiple sales channels in a go-to-market strategy, right? Not that it's confusing, not to the point where it's confusing, but if there's different buyers, up and down the market, I think you can build a little bit more of a sort of rocket-proof go-to-market strategy. It's a tremendous question, and it's really something actually, we're 2.5 years into being sort of, call it, professional investors here, and something we continue to scratch our head on is, what's a pre-revenue investor? Who are they? Oftentimes you see the founders come back and say, oh, they asked for more traction. Well, are they really a pre-seed investor if they're looking for more traction? So it is that funny sort of nuanced story back and forth. And it's certainly a challenge for founders and entrepreneurs, and we see it all day, every day. For us, though, I think, really comes back to, as you said, founder market fit, which is domain expertise, why the company was founded, what is the founder's story. Oftentimes, or many times when we sort of, I'll call it fall in love, is when there's a personal story behind it, which, some are certainly more pull at the heartstrings than others, depending on space. Again, B2B enterprise software, not always the case. And then one thing that we are very focused on is the operational experience, right? The chops, the ability to build a company. And I think for us, for founders, it's recognizing whether or not they know their own strengths and weaknesses, the ability to build a complementary team around them. Those are some of the key elements. And are they coachable? You can tell very early if a founder is just not open to that. So again, some of those sort of more obvious but softer reasons for recognizing whether or not you want to make an early pre-revenue type investment comes down to the founder. It's a great question. It's a loaded question. There's a lot of right and wrong answers. I think fundamentally the way we approach things, again, as operators, now investors, is about sort of company building, pragmatic company building and optionality. We do not believe in growth at all costs, right? I think you're seeing, and certainly with the more macro factors in the world today, a lot of companies have raised ahead of their ski tips, hadn't quite even established product market fit or repeatable go-to-market. They don't really understand their ICP. They don't understand their competitive landscape. And I think that's going to come back to bite some of these companies, again, that raised at large valuations. So we fundamentally think about, hey, what's the repeatability? Can you build, do you have the leadership and infrastructure in place to build a high velocity go-to-market engine, whether that's on the direct side or again on the self-service side? Do you have the leads to support, what you need to do in terms of establishing quotas and beating quotas and having that quota to, quota ratio, that coverage ratio? So I think it really comes down to, back to the bottoms up piece, is understanding if the way the model is built, it can support more velocity from an investment standpoint. Again, comes down to team, comes down to leads, top of funnel, comes down to awareness, comes down to brand. A lot of the elements that we're helping startups with much earlier in the growth cycle than I think a lot of startups start to think about that. So I'd like to say we see some earlier signs of that sort of time to invest or not, or level out go-to-market investment. But it's certainly there's certainly no one reason or thought process around too much. I just would say that we definitely think that growth at all costs is not the answer for all companies. And obviously sticking on the go-to-market topic, when oftentimes early stage companies, it's all founder-led sales, right? Which is fantastic. That's exactly the way it should be. And at some point in the cycle, there's a handoff to a more mature go-to-market engine. I think from a modeling standpoint, and as a former VP of finance, right? If you look at a bottoms-up model, and there's not enough people in seats to actually achieve that quota and get to that number of customers and scale. Oh, by the way, there's ramp up time for salespeople, right? Or there's not enough top of funnel from an inbound perspective, balanced with outbound. There's some simple math, quite honestly, that can be the flags on the field. I love that reference and might use that from now on. And that's one of the big warning signs in terms of go-to-market. Another one, and perhaps you'll laugh and the audience will laugh, sometimes we just see these models built with this outrageous hockey stick of growth. And while we would all like to think that that's possible, when I see those slides and decks, I tend not to look at the deck again. It's just unrealistic. It's, it's a hard model. Listen, growing a SaaS business by the nature of recurring revenue and how the numbers flow, it's really hard to achieve that outrageous growth. So again, that's another more obvious but flag on the field for us. And again, operational chops, right? Who's running the sales team? Who's running the marketing team? Is there a true partnership? What's the land and expand strategy? Are there flaws in the pricing model? Again, I'm just sort of throwing topics at you without going into depth, but those are a lot of the areas that we explore in our diligence process. Great question. For the quantitative standpoint, obviously it's revenue, it's retention, it's churn, it's net promoter score, it's product usage, product engagement, and internal sort of, client referrals. Are folks speaking positively about your product, about your platform? Are there referenceable customers? Some of those key elements. We oftentimes during diligence like to speak to customers to determine, how engaged they are with the product. I think that's a key element. It's a hard sort of, quantitative measure to put out there. But I think, as you think through, again, are you replacing a platform? Are you not? It's back to some of those key elements. How big is the market? Who are the customers, right? What's the customer profile? Who's the buyer persona? Do they have budget? Do they need to create new budget? There's a lot of factors that feed into it. And are there repeatable use cases? I think that's the key element that we look for, especially, with the early stage companies. Is everything a one-off and a customization of your product and, a random selection of features? Or is it, I'm using the full platform end to end. I'm using the full product end to end. I'm using, this feature set versus that feature set. I'm going to start with a, free trial or a paid trial, and I'm going to grow into the, the enterprise platform or what have you. So it's a combination of many of those things, to be completely honest, and it's different for every company. Absolutely. So fuel essentially, if you think back to fuel and why we built it, and one of the reasons, it was really what my team was doing at other companies. So as I mentioned, I ran corp dev teams and strategic development teams, and we were a combination of marketing competitive intelligence, product strategy, market sizing, strategic partnerships, and then the M&A universe, right? We started to use a little bit of that, obviously, in the early days of diligencing companies and sourcing companies. And the platform has really evolved today into, okay, what's going on in particular markets? Let's tag different ideas. Let's cross-reference. Let's have a database of companies. And then let's think about it in terms of growth, right? It is truly a growth platform that is capable of helping, whether it's your corp dev team, it's your product manager, it's your go-to-market leaders, it's your CEO founder who's just trying to understand, again, this whole market in approach we take, right? Which is really about strategy building and starting with strategy around marketing competitive intel and understanding that. We often see founders who are sort of heads down focused, singular problem, and not thinking about the broader market. How can we expose that in a quick and easy and digestible way? And that's our growth platform, right? So they can log in there, they can learn about their market, they can get insights on all of our advisory modules, right? We're going to automate more and more of that over time on that platform. But it's really that one-stop shop for getting the quick insights and intelligence that you need about your company, your competitive landscape, and your market opportunity. There's some great capability in there. We use a lot of, AI, natural language processing to match up topics, review content, pull in different sources of information. We can, do some simple stuff on looking at tech stacks of companies and determining, how sophisticated they are. Again, all important elements when you're diligencing a company, thinking about your competitors, thinking about your roadmap, really built for the growth mindset. I think obviously there's tons of optimism, especially from our seats. We're back in the office, as you can see. We're doing more in-person meetings. Listen, I'm blessed. Every day I work with founders and entrepreneurs who are passionate about what they're doing. That hasn't always been the case in other places I've worked. And what you're seeing today, and I read an article earlier this week about, obviously lots of folks are changing careers, quitting their jobs. You've seen those numbers change. Hidden in that article was a relatively large percentage of folks who are just leaving to start their own companies, right? So entrepreneurship is booming. It's never been easier to start a business. There's a lot of private capital out there, and maybe some of the macro factors change that in the short to midterm. But for now, there's tons of capital, and you're just seeing really interesting people who have already had fairly exceptional careers just saying, hey, now's the time. So good, bad, and different. The pandemic provided people with a little bit of maybe a kick in the butt to get out there and get the courage to start something new. So we're incredibly bullish and hopeful that we'll continue to see tremendous deal flow, exciting new founders who may not have left their comfy corporate job and gone to a startup. Now, it's not easy, so we'll see how we make it, but it's certainly encouraging to see the numbers of folks taking that plunge.
I totally agree. Well said in that particular case. And thank you for all these phenomenal insights. Yours is really unique in relation to the way, not just that you rethinking the way that venture is, but I really love the way you really shared about how these individual components come together. And should anyone in our community or the audience in general viewing this, Joe, find any form of affinity or fit for some of the things you referenced today, how do they best go about engaging york.ie?
So we have tons of resources, obviously, on our website of york.ie. We also are very active on social. You'll see that we put out a lot of content ourselves. So please feel free to follow along. And anyone can obviously reach out to me directly. I'm just Joe at york.ie. Happy to take any intros, answer any questions, tell people more about us. We're always looking for again, new founders, entrepreneurs, investors, folks in the market, key hires. We've got, again, a portfolio of about 32 companies at the moment. We've got another, about same size of advisory clients. At any given time, we're working with hundreds and hundreds of startups, folks coming in through the Fuel platform. So it's just a great place to come in, network, learn more about the startup ecosystem, and make some strong connections.
Fantastic. Well said. And thank you again, Joe. I know our audience is going to be extremely appreciative of this information. So thank you for taking the time with us today. We greatly appreciate it.
Thank you for having me.
Absolutely. And thank you for all of you out there for watching. You've seen york.ie's information on the side of your screen throughout the interview. Let us know if you have any questions or comments, and we'll see you next week.